Ladies and gentlemen, it is time for part 2 of our conversation with Scalp Trader, which means I'm going to welcome back in Damon, and we're going to run through a different set of examples so that you can get some context into some of his ideas and trading style. So, with that said, welcome back, Damon.
Hey, good morning, Jim. Thanks for having me back on.
Absolutely. So, one of the things that I think is very important is a way for the listeners and anybody on the in-play page to identify and find where your ideas are actually on the page. So why don't we start with that?
Yeah, so I post all of my swing trades with the secondary ticker Focus, F-O-C-U-S. So anything that's not intraday, so whether it's a yield idea, a swing idea, a distressed name, all of it goes under this focus ticker so that it makes it easier for customers to locate and to always know what my positions are, whether I've taken profits, they can pull up my original commentary, etc.
All right. And so I took the liberty of showing everyone how to do that on the in-play page for the Trader audio screen for you. And I typed in focus so you can see that. And what we're going to do is we're going to scroll down and we're going to first start with your TTS trade, right? TTS, the tile shop.
The tile shop. So, this is an interesting situation. It just kind of it provides an example of just my thinking on distressed situations. And I'm a big fan of these types of names just because the opportunity for upside can be so compelling. And these types of stocks aren't really impacted by all the algo trading that goes on these days. It's really more of a fundamental story that if you do the work, you can put up pretty strong gains. And but the other interesting part of it is that there's enough volatility in these types of names that you often get really kind of compelling entry points. So sometimes they'll be kind of thin, maybe news comes out, or maybe just the overall market drops sharply, and you might be able to pick these types of names up, say down 15, 20%, scoop them up, build your position out, and then ride them back up for the long term. So TTS, the tile shop, is a name that I highlighted, I think, last week. Initiated a 1/3 size spec position, which is a swing idea, but at the speculative level. So it means reduced capital, higher risk, but it's one of those that you're looking for 200, 300, 400% type of upside. So this company is a specialty retailer of natural stone and synthetic tiles. Operates about 140 stores in 30 states. They do about $350 million a year in revenues. Sales are on the decline a bit. Comp sales and net sales were down about 4% each in the most recent quarter. The gross profit margin is very strong at 69% for a retailer. Debt is about $63 million. It increased about $10 million last quarter. Due to the company drawing down its credit line in order to fund share repurchases. So this name got on my radar, I think last week it was, that they announced that they were eliminating their dividend and delisting the stock so they could reduce costs and just reduce business distractions. So the stock crashed from $3.35 to $1 in reaction to this news, which is pretty unusual news. And I stated that at the time, like, wow, you very rarely see a company just kind of come out of nowhere and say, we're going to delist our stock. That's pretty extreme action. And my initial thought was, this sounds a bit shady. I won't make any accusations, but it's a very unusual move. So I'm thinking, okay, let me short bounces because this thing's, this company's got issues. Eventually, it's probably going down to this, 10, 20 cents. So let me look to short bounces. So I kept it on the radar. But a couple of days later, you saw 2 directors purchase over $8 million worth of stock in the 155 to 170 area. So this is after it bounced from $1 all the way back up to 155, 170. They bought $8 million worth of stock, or about 10% of the market cap. And so to me, that suggests that these guys have a plan for this company. Like what they actually said of, reducing costs and reducing distractions is actually sounds legit. They're putting their money where their mouth is. And I think the ultimate outcome of this is that this is being dressed up to sell to private equity. And so when I see this type of commitment by insiders, a lot of times you'll see insiders come in and buy, $10, $30, $40,000 worth of stock just to kind of prop up the stock price a little bit. And the stock keeps going down. I mean, very rarely do you see people step up with this kind of money. I mean, they obviously have some type of plan. And so this is going to get delisted, I think, in the next couple of weeks. The stock could get hit, and I'm hoping for it to see it below 140 in order to maybe add another third to the position. This is just something I'm going to hold for a while. I think this, they're basically trying to clean the company up and sell it. I have no proof or knowledge of this, but just their actions suggest this to me. And but just an example of the type of name that I sometimes look at that can offer really compelling returns that often aren't on the radars of kind of the average investor, average speculator. So I wanted to kind of just break that down so you can get inside my head a little bit and how I think about some of these distressed names. I know it's a unusual strategy for most traders, but I've become a big fan of this since the 2007-8 financial crisis, just seeing stocks go from literally pennies back to dollars or tens of dollars. And, and so after that experience, I just really started to appreciate that, if you do your research, there can be just compelling opportunities where you can just make multiples on your investment.
So, quick question on this one. What happens after they do delist and you're still holding the stock? What happens?
So it'll start trading on the over-the-counter, and so it won't be officially, like it won't be on the NASDAQ or NYSE. It'll basically be picked up over-the-counter, so it'll still trade. I mean, I'd say 95% certainty that it'll still trade just because there's volume there, but what's going to happen is they're no longer going to do conference calls. They're no longer going to issue earnings reports. So they're essentially going dark. So it's a very speculative type of situation. But it's one that you can follow over time. I'll be following. And this is the type of stuff where I kind of take the research up to another level. So I'll be going to the stores to kind of check traffic and talking to salespeople who work there, and just also looking at competitors and just understanding kind of what's going on in the industry. Because these are really under the radar kind of turnaround situations that if you buy them right and you're patient scaling into them and build your position at the right price, you can do very well.
All right, let's turn back to your focus list, and in this case we're going to look at one of your yield plays. So I'm going to type in focus, and we're going to talk about the DCP preferred stocks. I'll scroll down so that everyone can see it on the in-play page, DCP, and these are the preferred. Now, do you own the common stock as well?
I do own the common stock, and it's in the portfolio. I think it actually goes ex-dividend tomorrow. So we own it, I think, at about a 13% yield, I believe. And you see, just scroll past the DCP, entry 24, stop 21, that's the common.
Got it. And you're also involved in the preferred. So why did you pick this one? What's so attractive outside of the yield?
Okay, so about once or twice per year in the preferred world. Now, a lot of people aren't familiar with preferred, so that's why I put this one on the list to kind of walk people through. So in the capital structure, a preferred is most of the time, almost all the time, senior to the common stock. So essentially with a preferred, in order not to get paid, the company would have to completely eliminate their distribution or dividend on the common stock. So that's your warning right there. Like, until the dividend or distribution is completely eliminated, there's extremely good chance you're going to continue to get paid on your preferred. And so with a lot of these MLPs, their whole entire structure is to be a dividend distribution distributor. I mean, that's their whole business model, right? So it would take quite a situation for them to eliminate the distribution. I mean, periodically during times of difficult energy prices, you will see reductions in distributions, but very rarely during normal periods do you see an elimination of the distribution. So in this case, you had a situation where preferreds were just getting sold in general, indiscriminately, and DCP preferred, which had been trading, I think, around $25. $25 is par for this preferred. Fell down to the $21 area, or $21.50 area, which brought it up to a yield of about 9%. And so looking at the fundamentals of this is a name that I'd already done research on, but I didn't find it as compelling at the par price. But once I saw it in the the 21.50 or so area, with that compelling yield, I knew that it was oversold and that it would bounce. And so, as I note in my review of on the post, I expected capital appreciation of at least 10% to go along with that 9% yield. And I think we got capital appreciation on this one of about 12% so far while collecting the 9% yield. So in the initial analysis, so we're looking at DCP midstream, which generates distributable cash flow of about $209 million a quarter, which is a 1.35 common unit distribution coverage. So to put that in perspective, their common distribution is over 10 times more in distributable cash flow than they're obligated to pay on preferred distributions. So basically, they'd have to have business decline so much that they would lose $209 million worth of cash flow before the preferred could not be paid. And so this is an example of a situation that, if you do your homework early and you kind of wait for compelling opportunities, particularly in the preferred market, you can find these really interesting plays.
All right. Now let's move into your moniker, Scalp Trader, and look at a potential or a particular scalp trade that you had. We're going to focus in PCG. This one's been all over the news because of the wildfires in California. That didn't scare you off. You got involved in this one, so you've played this one on the swing side, but in this particular case, we're going to talk about your day trade in this one. So walk us through how this one caught your eye and how you entered it and associated your risk and whatnot.
Okay, so with PCG, this is a situation where the company's already filed for bankruptcy. It's down 51% in less than 2 sessions. So the sentiment's already extremely poor. It's already a bankruptcy situation, and people are really trying to determine if there is going to be any type of equity value left in this name on the other side of the bankruptcy. And so you have a situation where you have new fires in Northern California that company could be held accountable for, which could completely eliminate the value of the equity. However, over the past couple of months and right now, there's actually a shareholder group in line to essentially provide financial support to the company in the billions of dollars as long as certain conditions are met. So there's been speculation with this name on an ongoing basis, and it's not 100-degree certainty that shareholders will be wiped out. So there's a fundamental component to the idea of, hey, the stock is down 50% in 2 sessions. There's a natural group of buyers out there, institutional buyers, and so really just taking advantage of a volatility situation to scoop up a name for intraday scalping opportunity.
All right. So that's how PCG caught your radar. Now, I'm looking back, and you got long on the 28th, so that was Monday, and you started with a 60-cent risk on this one. What's your preferred intraday chart?
That's a good question. So I'm less looking at technicals on a name. Well, on a name like this, I'm not really looking at technicals at all. I mean, it's more sentiment and a fundamental understanding of where buy pressure or sell pressure may come in. So with PCG, I'm looking more at the valuation levels. Where where an investor might consider buying this and based on upside where they can make money based on the entry point. So an institutional investor that's looking at this type of distressed situation could care less about the price technicals. They're looking at, okay, if I buy it at this level, I can possibly sell. If I buy it at a $2 billion market cap or 4 times, EBITDA, I can sell it at double that. The intraday price action on the charts is pretty irrelevant from that standpoint.
All right, but you didn't arbitrarily just pick 60 cents. Why was 60 cents kind of the magic number on your risk on this most recent one that you had on Monday?
Really, it was just to account for just some of the price volatility. So I felt where I purchased it, it was a compelling entry point from an institutional investor standpoint, but also attempting to accommodate some of the additional volatility, because obviously not every institutional investor is just going to step in at that exact level and just load the boat. And then you obviously have overhead supply of people who are down on the position and they're trying to sell that initial pop. So one of the things I try to scale into positions at 1/3 to 1/2 size in order to account for not being able to identify the exact low on the stock. There's have to account for some price volatility that goes beyond your initial entry point.
Was there any particular reason in this one? I'm looking back, and it looks like you took advantage of the nice pop from, it looks like you got involved at around 350 and took it off in the mid 4 range or so. Then it proceeded over the course of the next day or so to come back down to that 350-ish area. Is there any particular reason why you didn't go back at it?
Well, I didn't want to hold it overnight. I still liked it at the 350 area. I didn't want to hold it overnight just because of the risk associated with, these ongoing fire situations in Northern California and just the headline risk. So, and I've stated on the page, I'd actually been hoping that it would gap down the next morning so that I could get back into it. Unfortunately, it gapped up and kind of kept running. And so I just never got a clean entry. I didn't want to chase it. So my ideal scenario in terms of a re-entry just didn't play out. So I stepped aside.
All right, Damon, do you have any other pro tips that you might be able to offer as far as how to keep an eye on the page, to have things on your radar in just preparation, because I know you have a pretty large following?
Well, let me just quickly look through some of the questions that have come in and see if there's anything that might be helpful to a larger audience if I answer here. So for example, someone says this isn't a huge one, but they say they see an 8% dividend on DCP. I guess it just depends on where you're looking. So the dividend, and actually this is helpful because some people don't know how to do this. The dividend or distribution yield is found by dividing the actual distribution. So in DCP's case, it's $3.12 by the current stock price, which is $23.93. So $3.12 divided by 23.93 equals a yield of 13%. So little basic arithmetic, but it's probably some of the arithmetic I use most, and there are very few pieces of math that I learned in school that I actually use on an everyday basis, and that's one of them, calculating yields and percentages.
All right. Were there any others that you wanted to touch on? I don't see too many coming in.
Yeah, I think that'll cover it.
All right, Damon. Well, if anybody missed it, we will have a replay up for this, and again, it gives you a nice, a little more detail as to how Scalp Trader finds his ideas, and we walked through his distressed, his yield, and also a intraday day trade that you can take a look at and get into the mind of Scalp Trader. Hey, thanks a lot, Damon, for joining us and giving us a glimpse.
Okay, thanks, Jim.
All right, thank you.